Welcome, dear traders. Asian stock markets closed the week in the red. A batch of economic data in the United States gave the Fed more room to make an interest rate hike that confused equity buyers. Notably, the changes in the U.S. economy affect global markets. At the beginning of Friday, the news from China was also in the spotlight. It's me, Kate Stichina, and you're watching a recap of the Asian session on September 8th. The U.S. statistics continue to surprise the markets. The country's economy is performing much better than the rest of the world's economies. The fresh batch of data showed that the U.S. service sector unexpectedly gained momentum in August. And the number of unemployment claims last week reached the lowest level since February. This data provides the Fed with some room to keep the interest rate unchanged or make a rate hike, while markets still expect the regulator to leave monetary policy unchanged on September 20. Hawkish forecasts give an increased chance of a rate hike at the other two upcoming meetings. The prospect of the U.S. interest rates remaining at 20-year highs led to a sell-off in the global equity markets. At the same time, tech stocks came under pressure from recent decisions by Chinese authorities. The fact is that Beijing introduced restrictions on the use of iPhones by officials, and this has put the issue of a trade war between the United States and China back on the agenda. As a result, about $200 billion was wiped off from Apple's market capitalization in 2 days. The company's suppliers in Asia also came under pressure. For example, shares of the Japanese company Tokyo Electron 8035 slumped by about 4%. In addition to the China-US tensions, investors are also concerned about the data on the consumer price index in China, and this data will be released over the weekend and may show the strengthening of inflationary risks in the country. And today, the exchange rate of the Chinese currency has reached its lowest level since December 2007. Notably, the yuan has been steadily depreciating since February as the economic recovery in China slows down and the yield gap with the other countries widens, especially with the U.S.-China's main trading partner. As a result, the Chinese currency has dropped by about 6% against the U.S. dollar this year, and this makes it one of the worst performing Asian currencies. Meanwhile, the U.S. dollar has maintained bullish momentum for the 8th consecutive week. As a result, the U.S. dollar index has already risen by more than 5%. Given the challenges facing China and the strength of the U.S. economy, it's not surprising that the greenback is appreciated in the Asia-Pacific region. The bullish momentum of the greenback may be further fueled by expectations that U.S. interest rates are likely to remain at 20-year highs. And the U.S. dollar ended Friday's Asian session inching down within the range of 104.80 and 105.10. However, it's on the verge of its longest weekly winning streak since 2014. In yesterday's U.S. session, the world's main currency rose to 105.16. Notably, this was the highest level since the collapse of Silicon Valley Bank in March this year. The strengthening of the greenback has not only pushed the Chinese yuan exchange rate down to a 16-year low, but has also forced Japanese policymakers to act and step up measures to save the national currency. The verbal interventions by Deputy Finance Minister Masato Kanda and Bank of Japan official Hajime Takata have so far had little effect. On Wednesday, the former said that the authorities were not ruling out any option to curb speculative moves in the market, and the latter warned that the government was closely monitoring this situation. While the markets does not expect the Bank of Japan to intervene in the currency markets until the yen reaches the October high of 151.95, a move above 152 cannot be ruled out. On a Friday, the dollar-yuan pair was trading within the range of 146.50 and 147.50. The Japanese currency hit its lowest level against the greenback in more than 3 decades. During the Asian session, the yuan continued to weaken after a slight dip and climbed to 147.40. However, the main driver of the yuan's decline was the updated reports on the Japanese GDP growth rate. The reports showed growth of 1.2% in the second quarter of 2023 and downgraded the figure to 0.8% in the first quarter of 2023. Compared to the forecast of 1.5% increase, this data not only disappointed investors but also highlighted the fragile state of the country's economy. Furthermore, the reports confirmed that the Bank of Japan would continue to maintain its ultra-loose monetary policy. As a result, the yen lost its safe haven appeal and weakened against its counterparts. The Australian dollar also sagged on the back of a weak China and strengthening the greenback. As a result, the Aussie dollar pair lost more than 1% during the week, trading below 0.6390. Soaring oil prices should have pushed the commodity currencies higher. However, the decline in demand in Europe and China dampened their rally. Against this backdrop, the Australian dollar showed high volatility on a Friday, and the currency closed the Asian trading session higher within the range of 0.6370 and 0.6415. The New Zealand dollar followed its Australian counterpart today. The Kiwi managed to settle in the range of 0.5871 and 0.5915, ending the Asian session at 0.59. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in trading. And see you online soon.